So welcome everybody to New Forest Escapes and the tax seminar. I'm Jane Wilkinson and I'm the Managing Director of New Forest Escapes. Just to start off, I want to make sure everybody can see and hear me. So if you can either raise your hand, that would be great on Zoom, just so we can make sure that everybody else is, and I think a few, 7, 8, 9, okay, I think quite a few of you can see us, so that's great, thank you. So New Forest Escapes, we are the largest local independent agency in the New Forest, having organically grown since 2014 when we were founded. Now, 11 years later, we're proud to represent over 50 owners, looking after their properties, both part and fully managed. We've grown by focusing on high quality customer care, both for owners and guests. And that's why we're bringing you today this webinar as part of our ethos to help our New Forest Escapes owners, but also other owners in this sector. We felt that some clear guidance on the changing landscape for tax legislation was really needed before the end of the financial year and could benefit us at this time. So hopefully making the most of your accounts. So thank you for joining us this evening. We have got next Matt from Zeal, the specialist in FHL tax accountancy. He'll be talking through all the specifics for you because he knows what he's talking about. And then at the end of the webinar, we'll make sure that there's some Q&As in time for you to be able to ask questions. If we don't get to everybody, just write them all down and we'll make sure we get back to you afterwards. This webinar is being recorded, so if you can't be here for all of it, then don't worry, we'll send it to you tomorrow. So over to you, Matt.
Thank you very much for the introduction, Jane, and also thank you for inviting Zeal along today to present this webinar. I'm just going to share my screen now. Hopefully this all goes to plan. And confirm you can see that okay? Yes? Can someone confirm that they can see that okay? Because can you see it okay? Yep. Okay, so I'll without further ado, I'll get going. So again, thank you to New Forest Escapes for inviting us along today to talk to you about the tax changes for furnished holiday lets. I'll quickly introduce myself. My name is Matt Jeffery, and I'm one of the founding partners of Zeal. I have 20 years of experience, or over 20 years now of experience of working in tax. And the last 15 years, I've been focused primarily on property-related tax and capital allowances. And in the last few years, I have specialised specifically in short-term lets and the tax benefits and implications for holiday let owners. Zeal Tax is a leading capital allowances consultancy. We have been around for 8 years now. And our team have got over a decade or 2 decades of experience in unlocking tax savings on business property. And in more recent years, we have specialised specifically in the short-term holiday let sector. And on the right-hand side there, you'll see some of the key partners we work with. This year, we're chosen by PASC to be their partner for tax and capital allowances. And we also work with lots of companies like New Forest Estates, Sykes Holiday Cottages, and many more to help their owners to make sure they're paying the right amount of tax and make sure they're not missing any claims for tax relief. So the purpose of the session today, what we're going to cover is what are the tax changes for furnished holiday let owners, who will be impacted, and the ways you can potentially mitigate the changes. We'll then look at capital allowances and we'll see whether or not there's any opportunities whether or not you've missed a claim and any opportunities to identify any missed claims for tax relief on your holiday let business. And then we'll just quickly mention the business rates and VAT position for short-term holiday let owners as well. Hopefully everybody on this call is fully aware that the furnished holiday tax regime will be abolished from April 2025. The legislation is still currently draft, but we are expecting it to become part of the Finance Act 2025 and be part and will be then in force from the 5th of April 2025 for individuals. And if you own your property through a limited company, those rules apply from the 1st of April 2025. So the rules apply to companies and individuals unless I tell you differently during this presentation. So what does it mean? So from this will be the tax year we're in at the moment, 24-25, will be the last year of the furnished holiday let tax regime. From April 2025, your short-term lets or holiday lets will be taxed in the same way as long-term residential and commercial lets. So those of you who are familiar with your tax return, the property section is currently split in two, with the top half is where you declare your furnished holiday let income, and the bottom half is where you declare income from all other properties. So from April 2025, so tax year 25-26, all the income and expenses will be pooled together, and you'll pay tax on the net profits. Obviously, if you don't have any lets, then it will just be a case that your income expenses will all be shown in that one box, but the furnished holiday let rules will not apply. For those of you who are considering or about to start your journey in holiday letting, to qualify as a furnished holiday let in 24-25, you just need to get started before then, and that means making your property available for let before the 6th of April. And then you look past that date and you'll have 12 months then to check whether or not you meet the letting day criteria to qualify as a holiday let in the last year. And there are advantages of that, mainly around capital allowances, which we'll come on to shortly. So first of all, let's just recap what the furnished holiday let tax regime is. It was established in 1982, and I assume that there was a rise in short-term lets around that period. And the reason why they created this short-term let or the furnished holiday let legislation was because there was a difference between a trading business and a property business. And the government at the time obviously felt that short-term lets or holiday lets sat somewhere in the middle between a long-term let and a trading business, such as a hotel or a bed and breakfast. So there was these special rules which actually were very favourable. You had lots of the advantages of the trading businesses without some of the drawbacks of a property business. I think it's important for me just to mention here now that a furnished holiday let will encompass things such as service accommodation, self-catering accommodation, whatever terminology that you use. So it doesn't necessarily need to be used for a holiday purpose. It's more about meeting the criteria, which we will just recap quickly now. So to qualify as a furnished holiday let, the property needs to be situated in the UK or within the European Economic Area. It must be furnished, so sufficient furnished for normal occupation, and it must be let with a view to making a profit, so not just a second home. In terms of the letting days qualifying criteria, your property must be available for short-term letting for 210 days within the tax year. You then have to let that for a total of 105 days, and then during those 31 days, during the 105 days, you must not let your property to the same person for more than 31 days at a time. So that does give you the ability to let your property for over 31 days for 155 days of the year and still meet the furnished holiday let criteria. If you met the criteria in a previous year and you were unable to meet the criteria in the current year because of an exceptional circumstance, so for example, you're doing a refurbishment, there was a flood, and obviously COVID was a big reason previously, then you're able to make what's called a period of grace election. If you have more than one property, then you can average those days as well. So if one property underperforms, but the other one's overperforming, you can average them together. And as long as the average meets the criteria, then both properties will qualify as a furnished holiday let. It's important to note that the letting days criteria for furnished holiday letting is not the same as business rates. We'll cover that towards the end of the presentation. So what special tax rules are being abolished? The main one, or the headline one, is that you will no longer get full relief for finance costs. They will be restricted to the basic rate tax deduction only. I'll tell you what that means a little bit more in a moment. Capital gains tax, which is the tax that you pay when you sell your property. So that's your purchase costs less your proceeds of sale, and that you pay tax on the gain. So the rise in value is what you pay capital gains tax on. Joint owners of properties. So if you own property as joint tenants, so you own the property equally, under the furnished holiday let regime, you were able to allocate the profits to whichever owner you wished, and so that you could do that in the most tax efficient manner. Furnished holiday let income will no longer be classed as relevant earnings when calculating pension tax relief. I'll tell you a little bit more about that in a moment. And then perhaps the biggest change and what will have a quite a large impact is that capital allowances can no longer be claimed. So we're just going to go through each of these in turn, and we'll just give you a little bit more background on them and potentially some ways that you can mitigate these changes. So I think first of all, the relief restriction on interest relief for finance costs. The most common thing we hear is that, oh, I won't get any relief for finance costs anymore. Finance costs are typically things for holiday let businesses will be obviously the interest on mortgages to purchase your property, or if you've got maybe a hire purchase agreement on, say, a hot tub or furniture, etc. And if you pay interest on that, then that will also class as finance costs. For those that will be impacted, you'll pay approximately an extra 20 pence in the pound if you're a 40% taxpayer, and an extra 25 pence in the pound for a 45% taxpayer. So the best thing to do is give you a little worked example. So if you were a higher rate taxpayer, what we mean by that is a 40% taxpayer, and you previously had £10,000 of interest costs, under the existing rules, you could deduct the £10,000 from your income, and that would mean that you would get tax relief of £4,000. So £10,000 times 40% meant you get £4,000 tax savings. So going forward, you'll no longer be able to deduct that £10,000 from your income when you calculate your profits. Instead, you'll be able to claim what's called a tax reducer, and in this instance, it will be 10,000 times 20%, which will mean that you'll reduce your tax bill by £2,000. So in this example, the taxpayer would pay an extra £2,000 a year in tax under the new rules. So who will this affect? So it won't affect everybody. Obviously, if you don't have a mortgage or any finance arrangements, then there'll be no change to how you calculate your tax payable. Properties owned in a limited company are not affected because limited companies are not restricted by finance cost deductions, because I'd say they only have one rate. They only had one rate previously, but now, depending on the level of your profits, they're between 19 and 25%. So owners that pay tax at the basic rate and don't have much other income, you're unlikely to see any changes either. So just to clarify that, if your income, so if your taxable income from other sources, and including your profits from your holiday let without deducting the interest costs, is below £50,000, then you won't see any changes. However, if your other income, adding together your profit from your holiday let without the interest deduction, means that your taxable income is then over £50,000, then you will actually pay tax at 40%, even though you're currently a basic rate taxpayer. We have got a more detailed example in our ebook. The ebook is really a more detailed version of this presentation. It will give you an exclusive download of that at the end of the presentation. You'll be able to read through that in your own time and have a look at some of the examples that we have in there for you. So how can you mitigate the impact of the loss of the finance costs for deductions? The obvious one, I suppose, is paying off the debt. So getting rid of your finance costs. However, that is often not possible, and may not also be a good financial strategy, depending on your other interests and other sort of financial investments. The other thing that lots of people are looking at the moment is transferring the property to a limited company. This is known as incorporating, and as we just heard, limited companies are not affected by the interest deductions. The other option is you could potentially use an LLP or partnership structure. And what we mean by this is that you could potentially bring in, some other family members who could be involved in the business, and then you could allocate some taxable profits to them, meaning that you can reduce your taxable income and then avoid being subject to the higher rate charges. And then finally, an option could be to use a management company to operate the Furnished holiday let business. And what that means is that a limited company would receive the income, pay all the expenses, and then pay you back a rent. Now, you would still be potentially subject to the finance cost restrictions, because you have to pay a rent. You still have to pay the rent in your own name where the interest lies. And so this, for some, can be a strategy that will mitigate some of the impact, but it will certainly not eradicate it completely. So capital gains tax, as we've already heard, is the tax you pay when you sell your property. Historically, or under the current regime, there are certain capital gains tax reliefs that have been quite favourable. One of the key ones is something called business asset disposal relief. It was previously called entrepreneurs relief. And what it meant is that if you sell your property, if you stop your business and sell your property, you can be taxed at a flat rate of 10%. There was also the opportunity to gift or hold over the gain. So if you wanted to gift the property to a family member or somebody else, you could actually pass that gain on to them. And so they take over your base cost and they will pay your capital gains tax when you sell. And then finally, there was something called rollover relief. And this was the ability to reinvest the profits into another qualifying asset and then defer that gain until a later time. Unfortunately, these three reliefs will be withdrawn under the new legislation. So, as part of the new of the draft legislation, which HMRC released in July 2024, and since then they've also provided some comments on the draft legislation following a consultation process, just to give some clarity to the legislation that they released. All that clarity has been sort of covered within this presentation. So if you cease your short-term letting before the 6th of April or the 2025, BADR will still be available. And what the transition rules say is that you will still have 3 years to sell your property and qualify for business asset disposal relief. Unfortunately, in the recent budget, the Chancellor announced changes to the BADR rates. So from April 2025, the rate has gone up to 14%. And from April 2026, it then goes up to 18%. So if you cease your business before the 6th of April 2025, and ceasing means not having any more lets, and it's not about not stopping bookings, you must not let your property on a short-term basis after the 6th of April. You must cease the business at that point. However, if you don't sell your property until after April 2025, so if we assume you sell in May 2025, you will actually pay a BADR, a business asset disposal rate of 14% rather than the 10%. And then if you don't sell it then until May 2026 or May 2027, you will pay 18%. The current rates for the disposal of residential property are 18% and 24%. And that changes depending on the level of your gain and your other income. The advantage of BADR is it's just a flat rate that you apply to the whole gain. And then rollover relief. Previously, there was a period, you had a period of 3 years to reinvest the proceeds and defer the gain. That will still be available. However, in the past, you could sell a holiday let, purchase another holiday let, and that would qualify for rollover relief. But a furnished holiday let won't be a qualifying asset post April 2025. So your options are very restricted in terms of rollover relief. Profit allocation, which I mentioned earlier. So if you're a joint owner, you don't need to split the profits 50-50. You could allocate the profits to the lowest earner. That doesn't mean to say that you can't take the equal amounts of the profits, in your bank, but you could just actually dictate who you wanted to allocate the profits to. So if one of the joint owners had a lower income or had their personal allowance available, you could allocate your profits to them to reduce the amount of overall tax you pay. So Post April 2025, you will, if you're joint owners, which is known as joint tenants, sorry, you will then have to split the income 50-50. So one way that you can mitigate that is if you're a married couple or civil partners, you can do what's called a declaration of trust. To do that, you have to switch from joint tenants to tenants in common, and then you do the declaration of trust, which can say something along the lines of, Mrs. will be allocated 99% of the profits, and Mr. will be allocated 1%. But that declaration of trust does have to stay in place unless there's an exceptional reason why you would need to change that. This is a legal point which we're not allowed to give legal advice as tax advisors, so please do seek legal advice if you would like to use that as a mitigation strategy. Pension contributions. If you make a qualifying pension contribution, let's say, for example, that qualifying contribution is £10,000. When you make that qualifying contribution to your personal pension scheme, so this isn't through an employment or anything like that, this is where you physically make a payment to your personal pension scheme yourself. If it's qualifying, and let's say that the pension contribution was £10,000, HMRC would gross that up and put £12,000 into your pension pot, and then they would also extend your basic rate band by an extra £10,000, so that you would then get further £2,000 in tax savings as well. If you don't, in terms of what is relevant earnings, previously the profits from a furnished holiday let were classed as relevant earnings. So if you don't have any other income or qualifying income, then your maximum contribution you can pay, that you can make now and get tax relief on, will be £3,600. So if anybody does want to make a contribution to their pension scheme, please be mindful that 24-25 is the last year you can do that, and you would need to make that pension contribution before the 6th of April 2025. So then on to capital allowances. Capital allowances are a form of tax relief that enables you to offset capital expenditure against your taxable profits. And from April 2025, whilst you can't claim capital allowances anymore, holiday let owners will still be able to claim capital allowances on the replacement of domestic goods. So existing owners who want to replace their furniture, appliances, etc., you'll still be able to claim the tax relief on this. If you're new to the industry or you set up a new property after April 2025 and purchase those items for the first time, you will no longer get tax relief for those qualifying assets. Things like hot tubs, my guess would be that HMRC would not regard that as a domestic good. It certainly isn't within their list, and I think we might have a difficult time trying to get them to accept that that's a domestic good. The important thing, and one of the things that we want to stress through this webinar today, is that many owners are unaware of an extra level of capital allowance that can be claimed on their properties. And these are known as embedded fixtures within the fabric of your property. Tax relief can be claimed on part of your original purchase price, or construction costs, refurbishment costs, or conversion costs. And many people are unaware that you can claim these embedded fixtures. The transitional rules for capital allowances actually are really favourable. What the legislation says is that if you have any unclaimed capital allowances or losses, so capital allowances will often create losses. These losses, not only can you carry them forward after April 2025, but you'll be able to offset them against any UK property income. So if you've got buy-to-let properties and you make a profit from them, the capital allowances or losses that you have will still be available after the rules change. So you're probably wondering what are the embedded fixtures? What are the things that you can claim on? So that things like your electrical systems, heating systems, the kitchens, bathrooms, all your pipework, carpets, blinds, etc. Doors and windows don't qualify, but the handles and hinges do. Things like, there's some other things there you can see on that, things like security alarms, fire alarms, swimming pools, air conditioning, things like that. And in our experience, probably 4 out of 5 holiday let owners we speak to haven't fully claimed their capital allowances on their property. Your accountant would have claimed things like the furniture and hot tubs, etc. So, we often hear, oh, we've claimed capital allowances. Well, actually, you probably claimed the basic capital allowances, but you probably haven't claimed on the embedded fixtures. So why is that, I guess you're asking? Well, the main key thing is that it is a specialist area of taxation, and to be able to claim capital allowances, particularly on the purchase of a building that's used for holiday letting, you do need the skills of quantity surveyors and capital allowances specialists like Zeal. There is quite a lack of awareness of this, mainly because, as we've sort of alluded to already, is that accountants are unable to make these claims due to the necessary skills of quantity surveyors. The other thing that we hear more often than not is that, it's too late to claim. I bought my property 5, 10, 15 years ago. I did the refurbishment 5, 10 years ago. The property maybe was my house originally. There's no records available, particularly on and this is quite common on a refurbishment or construction claim. If you've engaged a main contractor to build the property or do the renovation works for you, you just get stage payments invoices from the contractor. That means that an accountant it's not possible to identify the cost of the electrical system, cost of the kitchen, etc. Our quantity surveyors were able to work without the detailed records, so to be able to identify the qualifying expenditure using a methodology and preparing a report that's in line with HMRC's expectations, and then enable you to make that claim. And then probably the biggest misconception we get is that if you claim capital allowances on your property, you will pay more tax when you sell in the future. So I'm going to give you just a quick example of that by what I mean. So if, for example, you purchase your property for, say, £200,000, you engage Zeal to do a capital allowances claim for you. We'll identify, say, £50,000 of that £200,000 that qualify for capital allowances. You can then take that £50,000 and offset that against your profits. At the moment, you can go back until the end of January. You can actually go back to your 2022-23 tax return and claim that deduction in last year's tax return to potentially get a refund for last year, and then you roll forward the savings until you use them up. Now, the misconception is that because you've had £50,000 of tax relief against your income tax or corporation tax if you're a company, then when you sell the property, you'll pay more capital gains tax because you will only be able to offset, say, 150,000, 200 less than 50,000 you already claimed against your capital gains tax. Well, actually, the capital gains tax legislation says that's not the case. And if you sell your property as a gain, you can still deduct the full 200,000, even though you've had £50,000 of tax relief against your income tax. So let's show you a couple of examples of how this works in practice. The first property on the left, Beachmount Holiday Apartments. This was bought as a family home in 2002. And then in 2018, the owners decided that they're going to convert it into a holiday let. And from that point, once they meet the furnished holiday let criteria, that property then qualifies for capital allowances. And in 2020, they made a capital allowances claim with Zeal. Out of the £352,000 purchase price, we identified that £92,000 qualified for capital allowances. In this case, the owner was a 40% taxpayer, and so that meant their total savings were £36,000, £36,800. So that's £92,000 at 40%. They were able to go back a year and claim make the claim in last year's tax return, and also then get the savings for the current year. And that meant that they had an immediate cash repayment after our fee of £5,500, and then they also had the remaining tax savings to roll forward as well. The property on the right, Frosty Brook, again, this was constructed as somebody's home. And then in 2009, 2010, it was constructed in 2009, 2010, and then in 2021, I believe, they then converted that to a short-term holiday let. And in this instance, of the £248,000 construction costs, we identified £89,000 that qualified for capital allowances. In this example, the owner was a 20% taxpayer, and so their total savings would be £18,000, and they had a £2,500 refund after our fee. The more common examples of is on the left of a refurbishment project, and this was a more recent project where the owners had spent £335,000 between 2021 and 2023 to fully renovate this property for holiday letting. And in this example, the main contractor done all the just billed them in stage payments, and they didn't have any detailed breakdowns. But our team were able to identify that £126,000 of the 335,000 actually qualify for capital allowances. And what that means, again, they're a 40% taxpayer, and what that means is that they will save £50,400 in tax. There was no immediate refund here because they'd only just started letting the property. And so what it means to them is that the first £126,000 of profits that they make from the property, they won't pay any tax on, which will save them over £50,000. There's a similar example on the right where there was a barn conversion for £285,000. In this example, they were 20% taxpayers, so we identified £65,000 of qualifying expenditure. You notice that's quite a bit less than the other property, even though the costs were incurred weren't there's not such a difference in the amount incurred. The reason why the qualifying expenditure less is because there was more structural works done on this project rather than they actually extended the property a bit, and so the structural elements don't qualify. But again, in this example, they did have a refund of £1,500 after paying our fee. So how does making a capital allowances claim work, or how do you go about it? Well, essentially, the first thing to do is you make contact with Zeal, and we can quickly determine what the scope would be for you to make a capital allowances claim. If you bought a holiday let, an existing holiday let, you're actually less likely to be able to make a claim for capital allowances. Now, I know it sounds a bit crazy, but that's how the rules work. So if you've got a residential property that you've converted to a holiday let, then you almost certainly can make a claim. If you bought a existing holiday let, it doesn't mean to say you can't make a claim, but the likelihood is it will be restricted. If anybody's thinking of buying a holiday let before the end of April, that's existing holiday let, contact Zeal and we can help you try and secure a full claim rather than a restricted claim. If the sale's complete, it's very difficult to go back afterwards and try and get you a full claim after the sale is completed. Once we send you our proposal, which sets out your entitlement, how much potentially we can save you, our credentials, methodology, etc., we'll then carry out a survey of the property if it's relevant. There's no additional cost for that. And then we will prepare what's called a capital allowances valuation report. It's generally about a 10-page report that gets submitted to HMRC with your tax return, and that provides all the evidence HMRC requires to be able to agree that claim without asking any further questions. We use a methodology that we've agreed with HMRC over a number of years, and so we get very, very rarely do we have any challenge on HMRC, and we've never had to adjust a holiday let claim to date. In terms of the process then is because Zeal are actually chartered tax advisors, we don't just give you a report that many capital allowances firms would do and then leave that with you to deal with your accountant, submit and process, which we know causes lots of troubles and adds additional expenses. Zeal will do all the tax work for you, so that means amending tax returns and submitting everything to HMRC. And then if they do ask any questions, then we will obviously answer them for you. Usually that process takes between 4 to 8 weeks. If you do think that you might qualify for capital allowances claim and you paid tax last year in your 2023 tax return, we will do our best to get that claim completed before the 31st of January for you. If you're just paying tax this month for the first time, then we do have a period of 12 months after the 31st of January to amend that and get and refund any tax that you paid and lock your savings in for the future. So if you spent £100,000 to purchase your property and probably over £50,000 to refurbish it, then you could be sitting on tax savings. On the purchase of a property, typically 20 to 40% of the purchase price will qualify. As we said, the claims will take anywhere between we've got 4 to 6 weeks there, but due to the changes, that's, some claims are taking up to 8 weeks. So with the rules changing, now is the time to review your capital allowances to make sure you've not missed a claim. You might hear that the claim, because the rules are changing from April 2025, that you need to make a claim by April 2025. That's not actually the case. You will have until you need to make the claim in your 24-25 tax return, which doesn't actually need to be submitted until January 2026, and then you'll have a year then to amend it. So if you haven't paid any tax just yet, and you're not planning on paying tax, within the next 12 months, then you do still have some time to make this claim. So don't panic. You don't need to do this straight away. You do have a little bit of time to submit that claim, but you do want to make sure that you lock it in before the rules change, or before the deadline, I should say, of the 31st of January 2027. That will be the last time that you will ever be able to make a claim on your short-term let. And as I mentioned, Zeal are a mix of chartered tax advisors and capital allowances quantity surveyors. So we're members of the the Chartered Institute of Tax, and we're RIC surveyors within our team as well. And as you see, we have quite unrivaled experience within the hard debt sector. We are the go-to specialists for this, and we do work on a success fee basis with no upfront costs. As part of the of our commitment to our owners, we will offer a free 50-minute consultation to see if you've got any unclaimed capital allowances in your property. And you can do this by contacting Zeal on the number there, or send us an email at hello@GoZeal, or you can actually book a call direct by scanning that QR code. So you can just take a photo of that, and then you can then go into your photos, and it should then bring up the link for you to go in and book a call in one of our team's diaries to discuss the capital allowances for you. So we're just going to touch on limited companies. We get asked this almost, on a daily basis. Should I use a limited company to run my, or to own my properties, or to run my business? With the changes in the rules, those who have mortgage interest, lots of mortgage interest, and a high rate taxpayers looking to restructure your business to a limited company can be advantageous. The key advantages of limited companies are that, as we've already mentioned, they are unaffected by the finance cost restrictions, and there's potential to pay lower annual taxes. There's an asterisk next to that, because that is not always the case. And often, or one example of that is that if you do need to withdraw all the money from the company to all your profits to live on, then that can mean that there might not be any savings. And that's because dividend rates have gone up, corporation tax rates have gone up as well. There's almost no dividend allowance anymore. And so, the disparity between, or the tax efficiency of using a limited company is less so than it was maybe 5-10 years ago. If you don't have mortgages on your properties and you transfer into a limited company, there's the ability to create what's called a director's loan account. That means where you transfer the property to the company, and they can owe you the money for it, and then you can take out all the profits tax-free, known as the director's loan account. A limited company also gives you some flexibility for inheritance tax planning. This is known as a family investment company. Again, we could do a whole presentation on limited companies and family investment companies, but essentially a family investment company is just a limited company with different classes of shares, which you can allocate to your dependents or beneficiaries. And what that means then is the rise in value of the business from when you do give those shares to when you pass away. That will be outside of your estate. The growth will be in your beneficiaries' estates. And then, of course, one of the key advantages of a limited company is that you do have limited liability, so the debts of the companies are not yours. So the disadvantages of a limited company: there are additional costs to run a limited company. So you still got to submit your personal tax returns, but you also have to do a limited company accounts and corporation tax returns. So I budget at least £1,500 a year extra to operate a limited company. The cost of raising finance in a limited company is often higher. However, that difference is shortening, but do expect to pay sort of 0.5% to 1% higher in a limited company structure. There's also an increased administration burden as well as the annual cost. You have to do things like board minutes, dividend vouchers, etc., and stay compliant with company secretarial compliance things that you need to do. As I mentioned, CT rates and dividend rates have changed over the past few years, which has mitigated the tax benefits of using a limited company. And then another important one is that if you are a director of the company and you stay at the property, then you will get what's called a benefit in kind, similar to like a company car. So you're getting a benefit from your company. So you'd have to make good the cost of your stay at the market rate to the company to avoid that tax charge. So just for the purposes of giving you a little bit of a steer in a short space of time, we'd only consider using a limited company if your annual profit's over £75,000 a year and rising. If you've got high interest costs and you're going to be impacted by the rules changed, or if you're a high rate taxpayer and you don't need all your income for living expenses. If you want to consider your inheritance tax planning position, then a reorganisation of your business into a limited company will be a good strategy. And it's a bit like a pension. The earlier that you start planning for your inheritance tax, the better the result will be in the end, just like investing in setting up pensions. And one of the key benefits of a limited company structure is that the rise in value, the capital gain, there's actually the ability to wipe out that capital gain, or not wipe out, basically wipe out the raise in value up to the date of transfer to the property. So if you incorporate your property in a certain way, you could sell it the next day and not pay any capital gains tax. One thing to be aware of is that stamp duty is likely to be payable, but there are ways that can be mitigated as well. If you transfer your property before April 2025, then we can be certain that no capital gains tax will be payable, but there should be opportunities to mitigate capital gains tax on transfer to a limited company even after April 2025. I mentioned earlier about if you were to use a management company structure where the company receives the income and pays the expenses, but it is crucial that there is a formal lease in place between the legal owner and the company. Otherwise, HMRC will class that as income shifting and wind that and charge you penalties for doing so. Now, I'm conscious of time, so just want to flick through these last couple of slides. So VAT is going to be unaffected by the changes in furnished holiday lets, and that's because of the VAT legislation is not the same as the furnished holiday let legislation. There's a couple of sort of tips, questions there. They're in the ebook, so I won't cover those now, conscious of time. Business rates, again, there's no impact. There's no changes to business rates. They will still be available to short-term let owners, holiday let owners. So that's a good thing. So if you let your property for more than 140 days, it's available for let for 140 days, 252 days if you're in Wales, and then it's actually let for 70 days, then you can apply to switch to business rates and not pay council tax. Most properties will qualify for small business rate relief, meaning you don't pay any business rates or you don't pay any council tax. Again, there's more about that in the ebook, and there's a perfect timing to give you the QR code to download the ebook. I'm going to put up both of the QR codes on here now. We've mentioned the incorporation and restructuring your business, etc. If you would like to arrange a call with us to discuss whether that is something that would be suitable for you, you can also arrange a call by using that QR code there, and we're happy to give anyone listening to the webinar today a free 15-20 minute call just to see what that opportunity might be for you and how that could benefit for you. When you arrange a call, if you could just be kind enough just to state whether or not you want to speak about capital allowances or about business restructuring, just so we can make sure that you get to the right person. So that's it from me. So back over to the team. And we'll field a few questions, and as Jane said, if we don't get through them all, which we probably won't, we will make sure that we issue answers to all questions afterwards. Okay, Jane, is that all right?
Brilliant, Matt. Thanks ever so much. That was really interesting. A lot of information to take in.
Yeah, not
So as I said before Matt started chatting, this presentation will be sent to you tomorrow for any of those people that are watching today. And it was just a bit too much to take in one go. So thank you. So now I just wanted to share my screen, if that's okay. And then we're just going to take you through just a little bit about New Forest Escapes. And we will also then just have some Q&As at the end as well. So please, we've had a few questions come in already. Please do, if you've got any questions for Matt or myself, please just start writing them down and we can try and get through as many as we can just at the end. I think we've got about 8-9 minutes left, so I will whiz through this and see how we get on. So New Forest Escapes, I've introduced us. We are a local business based in Lymington. It's our mission really to make holiday letting as hassle-free as possible. We are also proud to be a B Corp, which means we approach business in an ethical way, which is really important for what we do. We have an all local team who are based here, and so they know everything about the New Forest. What's important about being local is we know the area, which means we can price each of our houses uniquely, that we can talk to guests about each house because all of our team have been and visited each house. And it also means we can talk to our guests to make their holiday stay more enjoyable. So when we speak to them after they've booked, and we speak to everybody, it just means that we can have a chat and make sure their holiday stay is the best it can be, give them advice, and really make sure that they kickstart their holiday in the right way with that personal approach. What's the most important thing about holiday letting at the moment is marketing, is putting your property in the spotlight. So we spend an awful lot of money and time making sure that we have additional content like 3D floor plans, tours, and where possible drone footage as well. We also do a lot of videos. So in today's world, that's really important. And that's not just for launching the property, but it's also throughout the year to showcase each property, whether it's fires in the winter, swimming pools in the summer, really to drive that awareness. We've also got a fantastic following on our social media accounts, whether that's Instagram, Facebook, Pinterest, and that's all about driving people again to our website to showcase each property uniquely. Second most important is also revenue management. So this is about making sure you get the maximum return for your property. And that's about us knowing what we're doing. So we have our house captain, Rachel, and she oversees all the pricing on a daily basis for our properties. Her expert knowledge of the market area and that of our team is helped to tweak prices on a daily basis. It sounds ridiculous, but it's so important. And at this time of year, when there's so many bookings coming in, looking to the future, all year we do this, and it's so important to keep on top of that. So we don't just give you a price line and that's what it is for the year and then we discount. We actually look at it every single week, look at your bookings for your property, and we try and help manage those bookings forward. So proof's in the pudding. This last year to 2024, it was a difficult year. The market was oversupplied from COVID times, and we really needed to make sure that we were standing out for our owners. So we had a huge increase in marketing spend of 300%, which a little bit daunting, but what that enabled us to do was ensure that nearly 1 million people viewed our website in 2024, and we had an increase in over 20% of the total number of bookings taken. The revenues are slightly down on last year, but we've managed to keep those booking numbers up, which has been important, whereas a lot of other people haven't been able to do that. So we're really pleased with getting those bookings in. We're very lucky to have some fantastic owners, and we've got a couple of quotes here. We've also got some owners that are very happy to speak to anybody else about our service, what we do, how we do it. It's very important to us, that word of mouth recognition and recommendations. So there's more on our website, but I just thought I'd put a few up here today for you to have a look at, and that's part managed and fully managed houses. And lastly, we're just very proud to get the Brilliance Business Awards. So we were nominated and won New Forest Business of the Year. An amazing accolade for us that we got back in the end of November. We really believe that this is because of our business approach to looking after our owners and our guests, and we will continue doing that because that is what we are all about. So that's just a little bit about New Forest Escapes from me. So we're on to Q&As, and I can see that we've already got a few. So Matt, I hope you're ready. So first one for you, Matt, is can an owner backdate mortgage interest tax relief?
You can only, so because that's what's classed as a revenue deduction, you can only go back 1 year. So you could go back into your earliest open tax return. So if you fail to claim it in last year's tax return 22-23, then you can claim it in that year. But unfortunately, the years that you've missed, it's too late then to go back any further.
Okay, fair enough. That makes sense. You mentioned about pros and cons of being a joint tenant or tenants in common. Is the one that you think is more effective for FHL?
Okay, just to clarify that, so typically, if you buy a property, with a spouse or unless you actually dictate that there's going to be a difference in the ownership percentage, you will always be what's called a joint tenant. But by changing to tenants in common, you can or if say me and you, Jane, bought property together, and I contributed 80%, you contribute 20%, then we would want that. We would want to be. We would when we purchase, we would be tenants in common. Tenants in common, and it would say 80%, 20%. Now, it might be beneficial for people where going forward, where if you say one spouse earns more than the other in different tax brackets, then switching that to tenants in common. And changing that ratio could be beneficial. And you can do what's called a declaration of trust, which is a real simple legal document. It shouldn't cost much. And then you send that to HMRC on Form 17, and then HMRC will then accept that you've got a varied profit share rather than it be 50-50.
Okay, and just a follow-on question with me from that is, do you have to give any reasons why one person has a higher percentage or takes a higher percentage of the tax or not? No, you just literally.
No, you don't. No, the problem is that you can't, once you change that, because basically you're changing the legal ownership of the property. So you're actually legally saying that so there's other implications of that. Again, that's why we encourage people to take legal advice. You need to check with your mortgage provider as well to make sure that doesn't cause any problems there. But yeah, it's lots of people are considering it, and people already do it for buy-to-let properties. But yeah, just be mindful of the wider implications. If you're not spouses or civil partners, the HMRC have confirmed that they will accept that those who aren't that are joint tenants, but you operate as a form of partnership with a partnership agreement. Which says that the share will be allocated in different ways. They will accept that. So if you do run what you class as a partnership, and you can still share that income in different ways, depending on what your partnership agreement says.
Okay, brilliant. Basically ask you for more information.
Yeah, or you might need legal advice for some of that.
Okay.
We can certainly help and point you in the right directions.
Brilliant. Okay, another one. Does external work qualify as capital expenditure? So we've had our cracked concrete paving replaced and a replacement for a dilapidated garden shed.
Okay, so the repairs to your property externally or internally would normally be what's called, you can claim as a revenue deduction.
Right.
So you can claim that against as like a repair against your profits in the year. But the trade-off to that is if you claim something as a repair, then you don't get to deduct it again when you sell against your capital gains tax. So often you need to make a decision as to whether or not, do I claim that now or do I claim it in the future? The good thing about capital allowances is that, so let's say you replace a kitchen, under the old rules, you could replace your kitchen, claim capital allowances, and then so you get relief against your profits in the year. And then when you sell, you still get relief for the kitchen as well against your capital gains tax. When the rules change, you're now going to have to make a decision as to whether or not, do I claim that kitchen as a repair now, or do I keep that expenditure as improvements and then add it to my capital gains tax, take it from my capital gains tax when I sell? Again, that will depend on each individual circumstances. And so now the decision needs to be made, whereas in the past you could obviously claim capital allowances instead. The shed that you mentioned, because you're replacing the entirety of the shed, then unfortunately that would be capital expenditure and wouldn't class as a repair.
Okay, brilliant. And I think we've got a last one is, what will be the impact on the changes on a family holdover trust?
Oof, no idea. I'm sorry. I won't pretend.
I'm afraid I don't even know what that is.
Yeah, unfortunately, I'm not even going to pretend to try and answer that. I've never heard that terminology before. So
Okay.
we don't deal with trusts, unfortunately. Again, it's trust
So maybe
specialists.
speak to a specialist accountant that deals with trusts or legal.
Yeah, so there are. To be honest, it's more a financial advisor type thing, really, trusts and things like that. So, but you might find accounting practice will have people who will deal with trusts, but unfortunately, Zeal, we don't handle trusts. I'm sorry about that.
That's okay. I'd rather you didn't answer it if you don't know the answer.
Yeah, no, definitely not.
Thank you so much. That's all the questions. If there's any more that come through that we've missed for some reason, I'll double check at the end, and then we'll always get back to anybody tomorrow. And as I said, this is being recorded. We'll send out to everybody an email tomorrow with that recording. So thank you so much, Matt. It was really great to have you on board. And yeah, thank you, everybody.
Thanks, Jane. Been a pleasure.